Today's guest is Rob Arnott. Rob is founder and chairman of Research Affiliates, which he launched in 2002. The firm has $147 billion in assets as of March 31st. Rob and I have known each other for over 20 years, and we've had many great conversations over the past couple decades. I've always enjoyed our talks, Rob, because you bridge the worlds of academic theorists and financial markets, and you challenge the conventional wisdom in search of solutions that add value for investors, are things that I really appreciate. So, Rob, going back a few years, back to the 70s, you were a triple major in mathematics, computer science, and economics. And as a college student, you were, I think, quite forward-thinking at the time. This goes back to the 70s, because you were focused on applying science to investing, which is very different at the time compared to fundamental research. So would you talk about your perspectives at the time and how financial markets have evolved relative to what you had expected back in the 70s?
I was fascinated by the capital markets, and I was fascinated by astrophysics. Just before my senior year of high school, I went to a summer science program that compressed a year of college-level math, physics, and astronomy into a single 6-week program. So it was incredibly intensive. And it's the first time that I ever was surrounded by people who were better at math than me. And I was always pretty good at math, but I realized there were people who could run circles around me. And astrophysics is math, plain and simple. You cannot be an astrophysicist if you aren't world-class in math. So I realized, okay, I can be an average astrophysicist, or my other passion, investing. I can try applying scientific method to the investing world, where people operate on heuristics, rules of thumb, narratives, and boy, won't that be fun. And so really set out to get an education that would lead to a career in investing. And applied mathematics, computer science, and economics seemed like a nice fit for the way I wanted to think about investing. And worked out well. No MBA, no PhD, but more published papers than most professors.
But you were early in viewing or practicing science in investing. And obviously it's a lot more common now than it was back in the 70s. Has it evolved as you had anticipated? Is it faster, slower?
It's faster. It's harder to have an edge in application of quantitative techniques than it was at the beginning. I remember early in my career, Bar Rosenberg was one of the legends of early quantitative investing. And he was asked by a reporter, what does it mean to be a quant? And his response was, about 400 basis points per annum. It's a little harder today than it was then. But I would argue that the markets are becoming not more efficient, just more short-term efficient. That is to say, long-term opportunities are, if anything, bigger and better than they were in the past. Scientific method is not study the data, look for relationships that worked in the past, build a wonderful back test, and say, I've got a better mousetrap. That's not it at all. Scientific method is you start with a hypothesis, you use the data to test the hypothesis, but you don't use the data to tweak and improve the back test. Using a back test to improve the back test is a very surefire way to have a product that is not nearly as effective as you think it'll be. The back test, I've never seen so many billions of dollars moved on the basis of back tests as we see today, but back tests have different qualities. If you're doing a back test where you start with a hypothesis and you test it, you might find that live results are not too far behind the results in the back test, because that's a very light form of data mining. If you use a backtest to improve the backtest, pretty soon you get to zero efficacy, zero alpha strategies. And you and your customers are baffled how you could have a strategy that wins 8 years out of 10 in backtest and 2 years out of 10 in live experience. So I think the quant community has gotten addicted to backtests, and the marketplace feeds that behavior, encourages that behavior by allocating money based on those backtest results. So one thing that I find interesting is when we do show historical tests of our ideas, we'll often encounter people who say, oh, I've seen backtests that are much more consistent than this. Of course you have. We don't use the backtest to improve the backtest. We use it to test whether our idea has merit. It's the difference between data mining and Bayesian scientific method.
It can be very tempting for firms that are in the asset gathering business, which many firms are, whether they tell you that or not. It can be very tempting to create the backtest, build a strategy based on the backtest, show the backtest, grow your assets, charge fees, and so on. So you can understand why it may be more prevalent than perhaps it should be.
I totally get it. And our industry rewards that behavior. And so the behavior is endemic. There's three ways to think about science and hence scientific method. There's a theory-centric approach. Markets are efficient. Don't show me evidence that they're not. Return is linearly related to beta. Don't show me evidence that it's not. These are theory-centric blinders. There's data-centric blinders. And I think the multi-factor and factor investing community is just rife with people who have this approach. And that's to look through the data for relationships that look powerful. And then simply say, well, this works. But all you're proving is that this worked in the past. The data-centric approach, well, let's take quality or low beta, two very popular factors. It's interesting. If you go back historically, one of my pet peeves is that when you look at historical results for a model, people don't back out the portion of the return that comes from rising valuation multiples or rising multiples relative to the market. So I call that revaluation alpha. So if you take quality as a factor, for instance, high quality companies have a higher return than low quality companies. In historical testing, very true. Think of it from a theory-centric perspective. From a theory-centric perspective, why would you expect a bigger risk premium for a lower risk, higher quality company? Intuitively, I'd expect the opposite. So a theory-centric approach probably wouldn't have led you to a quality factor. The data does. Data-centric, you look back, quality is paid for. All right. Firstly, can it be arbitraged away? Yes. Secondly, how much of that return came from high-quality companies being priced at a premium to the market, and then that premium getting bigger and bigger and bigger over time? It's like if you have a stock where relative to its underlying fundamentals, the price has soared. The price has soared, meaning that the historical returns are brilliant. Same thing for a factor that's gotten expensive. If you count on that past return as a predictor of your future returns, you're committing two sins. One, you're assuming that past revaluation is structural alpha. It's not. It's non-recurrent. Two, you're overlooking the fact that if there's any mean reversion, past positive alpha can turn into future negative alpha. So revaluation alpha is very dangerous. If you have a data-centric approach, you're going to go where the data leads you. If you back out the revaluation alpha, you get a very different picture. It turns out that low beta has essentially no alpha net of revaluation. High quality has essentially no alpha. Well, not a no alpha, very modest alpha net of revaluation. And so net of revaluation, I would say, if you get any reward for a higher quality portfolio, that's a useful factor if it survives the net of revaluation metric. Low beta, if you can get a no higher return but less risk, that's a win. So I think these are legitimate factors that are overrated, oversold, but they're legitimate factors that are useful. Now, that data-centric approach is the heart and soul of AI. I'll come back to that in a minute. But the third approach, the Bayesian approach, starts with theory and asks what should work, and then uses data to test it. I think theory-centric scientific method is okay if there's no way to test it. String theory in physics is untestable, at least as far as I know. But it's a useful theory because it does fit very nicely in the way things operate at the subatomic level. Data-centric and ignore the theory works if the data is vast. That's the essence of AI. A Bayesian approach blends the two. It starts with theory and then it uses the data to test the theory. In any situation where you have enough data to test an idea, to verify that the idea stands up to historical testing, the Bayesian approach is useful. If you have a ton of data, you can throw out theory and just follow the data. But by a ton of data, when people talk about applying AI in investing, they're forgetting that AI is enormously data hungry. If you have thousands of samples of data, AI is useless. It won't do remotely as well as an ordinary least squares regression. If you have millions of samples, maybe you're getting somewhere where AI can help a little bit. If you have billions of samples, now you're talking. If you have trillions, now you're really talking. If you have billions of samples, tick data. High-frequency trading has been using AI for a generation now. AI is not new. User-friendly AI is new. But when it comes to high-frequency trading, there's billions of samples of data, and you don't need a theory. You just need the data to gauge, is the next tick likely to be up or down? So organizations like Citadel, they're on the other side of maybe 10 or 20% of all trades. I don't know the number, but it's in that ballpark. And so if there's a bid-ask spread, their algorithms will say the next tick is likely to be up. Therefore, I'm happy to pay a little more than the bid. So whenever they trade, they're tightening the bid-ask spread. They're doing a huge service to the efficiency of the market and minting money by doing that. I don't fault them for minting money by doing something enormously useful. Good for them. But anyway, scientific method is not new. It's surprising that it's not widely used in the hard sciences, and it's unsurprising that it's not widely used in the soft sciences like finance.
It's pretty fascinating. What you just talked through demonstrates that you're in rare company as both an academic theorist as well as a financial markets practitioner. You kind of express the spectrum. Theory on one side, practice on the other side, and somewhere in the middle is probably a good place to balance. And so you've published over 150 academic papers and launched your own firm, which is almost 150 billion in assets. What drove you to pursue both of those paths simultaneously?
The academic aspect, I think, hews to curiosity. I think I have intense innate curiosity. When I hear someone say, this is how things work, I just instinctively say to myself, has anyone tested that? Let's take a look. And as often as not, often you test it and you find, yeah, it's true. Cool. Sometimes, a shockingly large fraction of the time, it doesn't stand up to testing. I'll give a totally off-the-wall illustrative example. I read a respected Bloomberg columnist fretting that with the magnitude of our deficits, if we have a downturn, we don't have enough dry powder to boost spending and stimulate the economy and soften a downturn. That's a very conventional Keynesian worldview. And I went and got historical data across all the OECD developed economies. I shouldn't say I did. One of our colleagues, Alex, did. But in any event, we went back and we asked the question, do deficits correlate with GDP growth? And does spending correlate with GDP growth? We found deficits have really squishy correlations. You can't really find anything there. Spending does. If spending goes up, GDP goes up in the year of the spend. Well, why is that? It's because spending is part of GDP. GDP includes government spending. So it doesn't mean you're more prosperous. It just means the spend is higher, therefore GDP takes a pop. But averaged over multiple years, once you start looking at rolling 10-year spans, higher spending over the course of a decade correlates highly and I think leads to slower GDP growth concurrent to that during that decade. And it's a powerful relationship. Per capita GDP growth, if you regress across this, is 4% per annum minus 6% times the spend, which means that if government spending is 2/3 of GDP, you should expect zero real per capita GDP growth. If it's half that, you should expect 2%. I wouldn't go so far as to say if government spending is zero, you should expect 4%, because then you'd have anarchy and chaos. But some government's absolutely essential. Anyway, the point of this digression is here's a widely held view across pretty much everyone in the academic economics community that spending can stimulate the economy, and tangible evidence that on a very short-term basis, in the year of the spend, it does, and on a longer-term basis, it saps growth, macroeconomic growth out of the economy. So I love finding situations where the conventional wisdom is dead wrong. One of the things that I've found fascinating over the years is how when you show that some element of theory or conventional wisdom is wrong, it startled me for years and years and years how angry some people would get. And I then realized that by showing that conventional wisdom is wrong, people who are building their career based on that particular slice of conventional wisdom are livid. They don't want to hear that the thing that they're building their future on is an illusion. So I've gotten used to the fact that I piss a lot of people off.
It is pretty fascinating. And in my experience, there just aren't that many independent thinkers. You know, we're taught that this is the way things work. We learn it and then we repeat it and don't really challenge. And then, like you said, a lot of things you don't have to reinvent every wheel, but it's good to at least make sure that it's accurate with your own independent study and analysis.
That's what I find just a source of great joy and great fun, is finding things that are unexpected, like that result of minus 60% correlation between what a government spends and how fast the per capita GDP grows. Minus 60%. It's astounding.
Let's talk about research affiliates for a second. You have a relatively unique structure because you have significant assets, but you don't actually manage the money. Would you discuss the structure, why you set it up that way, and how your vision has evolved with time?
Well, firstly, I was running first quadrant when I decided to launch research affiliates. I did not like the parent company. their philosophy on priorities for a business were very different from mine. I have a long horizon view. I like to build for the future. I like to pursue ideas that I think could be important in 5 to 10 years. I don't want to focus on what's the quarterly distribution going to be to shareholders. So I decided to set up my own business, but I offered the parent company a transition where I would stick around, continue to be chairman while starting my own business. And when the transition of responsibilities to the successor team was done, they or I could pull the trigger at any time to break the tie and move over. And that worked really nicely. The transition was 2 years, and we lost 0 clients because of my decision to move on, which I'm proud of to this day. I wanted to not have conflicts of interest. So initially, I was not running money. I was bringing investment ideas to others. Our first relationship was with PIMCO. That relationship is now 22 years old. It's been a fantastic relationship. Bring ideas to distribution partners and have them run the money. Now, what does that do? That means that from our perspective, our affiliates are our distribution arm. They are how we distribute our product ideas. We don't have to have a deep marketing team. We do have a little marketing team, which supports our affiliates, but we don't have to have a deep marketing team. We don't have to have call centers. We don't have to have a trading desk. We don't have to have trade reconciliation. We don't need to do portfolio accounting or client reporting. We don't need to make quarterly or annual visits to clients, except the distribution partners, of course. And from the perspective of the affiliate, we are merely an extension of their R&D capabilities. An organization the size of PIMCO or Legal & General or Schwab or Invesco or FTSE, all of these are big relationships for us. They all have R&D capabilities. They don't need us. So they will find us useful if, one, we bring them ideas that they wouldn't have thought of themselves. 2, we bring reputational capital and brand that helps them promote the idea. 3, the products have to be complementary to what they're already offering to the marketplace. That nobody wants to launch a product that's going to cannibalize their core business. 4, they have to have high confidence that the ideas will work and will reflect well on them. So these are high hurdles. They make it a very difficult business model. But if you go into it with an idea of, we're here to help, we are not here to compete with your R&D capabilities, we're here to help, and we're here to bring you ideas that may be complementary and highly likely will be useful and profitable to your clients. And we're not going to be greedy. We're going to take a modest share of the revenues. Depending on the strategy, our share of the revenues can be, as little as 10% or as much as about 30%. It depends on the product, it depends on the relationship, and it depends on the amount of actual work we have to do to manage the relationship. But if you're not greedy and you're bringing something of value to them and their clients, the strategy, the business model can work. I think because it's a difficult business model, that's the reason that very few people have ever pursued it.
But it's brilliant in a way that it is highly scalable. You don't have to hire, thousands of people to keep scaling because it's just your ideas that you're distributing.
We've got about 70 people involved indirectly in the management of 147 billion of assets. That's cool.
That's a great ratio. 2 topics that I know are near and dear to your heart and have been for decades is tactical asset allocation and fundamentally based indexes. Would you explain these 2 areas and why you gravitated in those directions?
Well, tactical asset allocation has been on my radar screen for almost my entire career. I started my career in 77. I wrote systematic asset allocation in 82 in the Financial Analyst Journal. And asset allocation back in the 50s and 60s wasn't on anyone's radar screen. Pensions were run by the local trust department of a local bank. They were run using rules of thumb. They were bond-centric in the 50s and became equity-centric by the late 60s, concurrent with a stupendous bull market from, I think, 1949 until 1968. And that sowed the seeds for people to realize that, oh, asset allocation does matter. There was a paper by Brinson, Hood, and Biebauer in about 1984-ish that showed that over 90% of the differences in return between pension funds were a consequence of the asset allocation decision, and the asset allocation decision got very little attention. So when we wrote the paper Systematic Asset Allocation, I was just of the view that, boy, if the markets are inefficient anywhere, it should be between market A and market B, much more likely than within market A. So between stocks and bonds and international. We looked at just a simple stock bond cash asset allocation model in that paper in 1982 and showed that you could add hundreds of basis points by being disciplined and systematic about asset allocation. Now, of course, some of that's been arbitraged away. I think adding 1 or 2% is a more reasonable target these days. I remember a fellow named Bill Faust, who ran the asset allocation work for Wells Fargo at the time, came up to me after the paper was published and said, "You son of a bitch, you let the secret out of the bag." And I said, "Bill, you just watch. You've been in this business for 6 or 8 years now. You're the standard bearer. You have overwhelming market share. Your growth is going to be stupendous because of this paper. I may nibble away at the edges of your market share, but you're going to see some big growth." And of course he did. It's the nature of any business that a little bit of competition increases the growth rates. Anyway, that's been an area of fascination for me. I've looked at it from lots of different angles. Simple rebalancing. Just if you put half of your money in stocks and half of your money in bonds in 1926, the start of the Ibbotson data, and just let it run, you get a return that's moderately less than that of the stock market. But by the end of that nearly 100-year period, you're about 98, 99% stocks just because the returns were higher. And if you rebalance, you have a lower return. So why would you want to rebalance? Because your risk-adjusted return goes up. Your risk-adjusted return with a drifting mix goes down. With a rebalanced portfolio, it goes up. And that caused a little bit of a mystery for me. It's a rebalancing alpha. And it turns out you can find rebalancing alphas just about anywhere. It's really quite remarkable. So I was also fascinated by the use of quantitative techniques in equity portfolio management. My first job as a portfolio manager was late 81. And actually, the guy who hired me for that gave me a call about 2 years ago. And we had just a wonderful combination. He was, of course, long retired. But in any event, what I did was very simple. Score stocks based on a variety of attributes. What's its PE ratio? What's its dividend yield? What's its volatility from a perspective of higher risk, maybe has higher return? Back then, it did. And what about volume of trading? Is volume of trading trending up or down? Simple ideas that made sense and then survived a back test. So I was already start with an idea and then test it. And we went live at the end of 81, and the strategy actually did very, very nicely. So I was interested in quantitative equity investing. You could say that that 1981 strategy was an early crude form of multi-factor, because multi-factor does much the same thing. Multi-factor has gotten way more systematic and way more refined and way better risk managed than it was back then, but also way more data mined. So the fascination with asset allocation and with quantitative equity techniques has really been central to my career.
Let's talk about value investing for a second. I know it's something that you've been focused on for a long time. And it's interesting if you look at the last, 10 plus years, value has trailed growth. It's been a long run. And a growth investor.
It peaked in early '07 and hit rock bottom in summer of 2020. So it was a 13 and a half year drawdown. And we're bottom bouncing. We're back down to the lows of the summer of 2020 right now. This has been a brutal environment for value investors. Many of them haven't survived.
And if you were to ask a growth investor, they'd say, well, growth companies are just better companies and they've delivered on their earnings and they should continue to do so. So I guess the key question is value dead, or is this just another cycle that is maybe extended and will mean revert at some point?
In the investing world, whatever is dead can come back from the dead. The equity risk premium in the summer of 2000 was dead as a doornail. You could get 4% real from inflation-linked government bonds, 4% guaranteed by full faith and credit of the U.S. government. That's cool. And at the same time, the stock market had a 1.1% dividend yield. So in order for stocks to match bonds, you'd have to have earnings and dividends grow 3% over and above inflation, real growth of 3%, where the prior century had seen real growth of 1.5%. So by that simple arithmetic, if you continue with real growth of earnings and dividends of 1.5% and a 1% yield, you get a 2.5 real return. And that's if those record valuation multiples stayed intact, which they didn't. So I wrote that piece, Death of the Risk Premium, pointing out that simple arithmetic told us that the risk premium was dead as a doornail. But I made the comment in my Death of the Risk Premium paper in closing. I said, like the phoenix, the risk premium can come back from the dead. All it has to do is have bond yields go down and stock yields go up, which they did over the latter did over the next decade. Anyway, is value dead? I wrote a paper in 2021, FAJ paper, reports of value's death have been greatly exaggerated. I started the research on that by not trying to prove that value was okay, but trying to test whether all of the pronouncements that value investing is dead, test whether there was merit to those ideas. If you looked at the returns, absolutely, the returns were awful. Value did badly for a decade and then crashed for another 3 years. Just an outright crash. It was horrific. But what we found was my old friend, the revaluation alpha, was the culprit. Value stocks were priced, if you use the Fama French methodology, value stocks were priced at about 1/3 as expensive as growth at the peak for value in 2007. Now, a 3-to-1 ratio sounds like a big spread. It's not. It's only been tighter once before in history, and that was in the 70s. The spread widened. The norm is 4.5-to-1, and widened and widened and got to a 9-to-1 ratio. What does that mean? It means that valuations fell by 2/3 relative to growth stock valuations, from 1/3 to 1/9. That was even cheaper than at the peak of the dot-com bubble, which is really quite astonishing. I never thought I'd see a bubble of that magnitude again in my life. But 1/9 as expensive is off the charts. The market was saying these companies, these tech companies, are beautifully positioned for a pandemic and a post-pandemic world, and these bricks and mortar companies are toast. There's going to be rolling bankruptcies across all of mainstream America. Watch out. And as with most narratives, there was truth in that, but it was already embedded in the price. Price already reflects the fact that these are better companies and these are more troubled companies. So how bad were value stocks hit relative to growth stocks? They underperformed in those 13 years by 57%. Well, if they underperform by 57% and get cheaper by 67%, what does that mean? It means if the relative valuation had stayed the same, if value was no less out of favor in 2020 than in 2007, value stocks would have outperformed by about 2% a year. So my takeaway from that is value isn't dead. It's just fallen wildly out of favor, which it does from time to time. Today, we're back to the 9-to-1 ratio. The AI narrative has taken over the entire marketplace as the theme of the century. And as with most narratives, this narrative has a lot of truth in it. These companies are going to revolutionize the way you and I do business, the way we communicate with our clients, the way we do our research. It's the same as the dot-com revolution was very real. But when you go back to 2000, look at the 10 most valuable tech stocks in the world in the year 2000. How many of them had beat the S&P by 2015? 0. By 2020, 1. Microsoft by about 1.5-2% per annum. Today, 2. Microsoft and Oracle. If you look at those 10 most valuable tech stocks back in 2000, my favorite poster child is not pets.com, which was a stupid idea. My favorite is Qualcomm, which was a brilliant idea. Qualcomm, the narrative at the time was this company produces the plumbing for the internet. It is absolutely needed. It has a big moat. It's very hard to build the infrastructure to compete with them. Its profit margins are big and getting bigger. Does this sound familiar? And it has growth as far as the eye can see. It came into the year 2000 with a PE ratio of 284. Now, that narrative was this company is going to see stupendous growth. How's it done as a business? Profits last year were 60 times the profits in 2000. 60-fold growth. So it must have performed well. Nope. If you bought the S&P in 2000, you're twice as wealthy as if you bought Qualcomm. Qualcomm's gone up nicely, but half as much as the S&P. That's what happens when things get frothy. So I look at today's markets and I think history doesn't repeat, it rhymes. That quote has merit. We're looking at a situation today that looks very, very similar to the peak of the dot-com bubble. Valuations aren't as stretched, and the profitability is deeper and more real than in the dot-com bubble. But, as of last Friday, NVIDIA was at 36 times sales. Now, Scott McNally from Sun Microsystems famously was interviewed by Congress for a variety of topics back in the early to mid 90s. And he famously said, when asked about privacy, he said, "There is no privacy. Get over it." The other quote was, he was asked about the valuation of his company. And he said, "We're priced at over 10 times sales." I don't know how anyone can justify a price like that. And here's a company at 36 times sales. So we did a little simple back of the envelope. NVIDIA has a moat. It utterly dominates the super chip market. It's a beautiful company with beautiful product. The product works. So the question is, they've got over 50% profit margin, net of all cost of production of the product, net of all R&D, net of all taxes. Wow, that's a stupendous profit margin. So what could possibly go wrong? On a 1 or 2 year horizon, nothing. There is no serious risk to NVIDIA over the next couple of years. But does anyone think AMD, Intel, and Taiwan Semi are going to sit on their hands and say, you can sell $40,000 chips with a 55% profit margin? That's okay with us. It's hard to break into that business. You have a moat, and we're not going to try. No, of course they're not. So competition is a natural part of the economy and part of what makes the economy move and grow and change for the benefit of everyone. But you're going to see competition. Disruptors get disrupted. Back in the year 2000, Palm was a spinoff. Palm made the Palm Pilot, the ubiquitous Palm Pilot. Everyone had one in the late 90s. And 3Com owned Palm and decided to spin it off as its own company. The spinoff was instantly worth more than 3Com before the spinoff. Very cool. It was within days worth more than General Motors. 2 years later, BlackBerry came along and Palm was irrelevant. 5 years after that, the iPhone came along and BlackBerry fairly quickly became irrelevant. I was giving a talk a few weeks ago and asked the audience, how many of you still have a Palm Pilot? Of course, no hands went up. How many of you still have a BlackBerry? Out of about 300 people, 3 hands went up. So disruptors get disrupted. NVIDIA is a disruptor, a massive disruptor, a massively successful disruptor that has great product, visionary management, and a moat. Fantastic. But let's suppose that pricing pressures bring the price down by half over the next 10 years. That seems in the tech arena to be probably an unduly optimistic view. Let's assume that market share for NVIDIA goes from 90+% to 40 or 50%. Let's assume that volume of production of super chips rises 25% a year for the next decade. Just stupendous growth. Put those 3 assumptions together, and what do you get? You get a profit for NVIDIA in 2034 that's smaller than in 2024. So I'm not saying that we're at peak profit for NVIDIA. I'm saying that we could well be at peak profit this year and next for NVIDIA. And it would be very dangerous to assume that 36 times sales will be justified. Now, in fairness, the 36 times sales is backward looking. It's the last 12 months. As sales, as everyone knows, the sales are right now running about twice what they were a year ago. So double the sales, you chop the price to sales ratio in half, that's still 18 times. It's wild. So I look at this and I think, as always, growth companies are, for the most part, much better companies with better products, better finger on the pulse of their marketplace, better management, better strategy for competing. Value stocks tend to be the opposite: weak product, weak management, weak strategy. And that narrative is correct. The parts of the narrative that fail are the narrative that these leaders will still be the leaders in 10 years. These losers will still be losers in 10 years. And that change is going to happen fast. So the stupendous growth of Qualcomm or of NVIDIA will persist for years to come because change is coming and coming very fast. The internet changed everything. But is the world of 2024 different from the world of 2000? Oh my God, yes. Was the world of 2002 radically different from the world of 2000? Well, geopolitically, yes, we had 9/11. But in terms of the economics, the functioning of the economy, the depth of penetration of the internet in day-to-day life changed gradually. And the embrace of AI will happen gradually. It's not that the change is going to be slow, it's that the adoption is going to be gradual. We have a quarterly all hands meeting, and first quarter of last year, I spoke with our team and I said, you're hearing a lot about AI, and it's very real. It is revolutionary what's happening. But you're also hearing that it will cost millions of people their jobs. Let's not forget it'll also create millions of jobs for those who know how to use it. Now, you might be worried because you're reading about all these white-collar jobs that are going to disappear. I can guarantee you not a single person in this room will lose your job to AI. You might lose your job to somebody who knows how to use AI better than you do, so start studying. And I think that's the way to think about any technological change.
There was two key points in what you just talked about that I think are particularly insightful. One is valuation is reliably mean reverting. And you always have to look at it through that lens and kind of where are you in that cycle. You don't know when it's going to turn, but it's going to be mean reverting. That's just how capitalism works. And then number two is if you, and I've heard you say this before, if you bet on the narrative, you basically haven't bet on anything because the narrative is already in the price for the most part because that's the conventional view.
That's exactly right. Narratives shape pricing. Prices move based on changes in the narratives. And if a narrative is these winners are going to be big winners for a long time to come, these losers are going to face headwinds for a long time to come. If that narrative is true, it doesn't do a bit of good for you, just as you said. For that narrative to be useful, for these stocks to outperform, they have to do better than lofty expectations. For these stocks to underperform, they have to do worse than bleak expectations. Can that happen on a short-term basis? Absolutely. On a long-term basis, mean reversion exerts its influence powerfully and reliably.
It can also be self-fulfilling and also self-reinforcing because as the as you have a strong narrative and with the tailwind there, more people get interested, they invest, price goes up, it supports the narrative until it gets extrapolated to a point where it's unrealistic, even for companies that are growing rapidly. And I think it's also related to the fact that you have humans. Now, I guess you have some computers, but it's mostly humans that set the price. And humans are hardwired to be emotional. And, they're oftentimes driven by fear and greed. So that probably hasn't changed in, hundreds of years.
Yeah, and it's rooted in human nature and we're shaped by evolution. A bargain typically got there by inflicting pain and losses. A frothy, overpriced stock typically got there by producing profits and great joy. And pain and losses, we don't want more of that. So if something's hurt us, the last thing we want to do is buy more. If something's helped us, the last thing we want to do is take our profits. I like to say that our ancestors on the African veldt didn't thrive by running towards a lion. But when it comes to investing, running towards what's out of favor, what feels dangerous, is a reliable path to long-term success. Here's that problem. On a short-term basis, the likelihood of your picking the trough is slim to none. So you buy something that's out of favor, that's inflicted pain and losses, and you're going to look and feel like an idiot until the turn happens. But the only way to have maximum exposure when the turn happens is to be willing to buy more if the narrative that prompted you to think it was a bargain is still true. So you ask yourself the question, is the thesis on which I liked this asset at this price still intact at the lower price? If so, top it up.
And this is all also related to your previous point about the rebalancing. Buying low, selling high. That's basically what rebalancing is. And the challenges of doing that in a paper, it's obvious, and the challenges relative to doing it in practice, where human emotion comes into play.
One of the things I've loved to do over the years is find ways to institutionalize rebalancing, buy low, sell high, into our investment processes. We do this in our asset allocation work. We do this in fundamental index. With fundamental index, you're weighting the stocks in the portfolio based on how big their business is. So whatever the size of the business, that's how much you put into it. Growth stocks are priced at premium multiples. So tacitly we say, love the company, but the narrative's already in the price, so I'm not going to be hurt to reweight it down. Value companies trading at deep discounts, yeah, the company's got headwinds. I get it. That's why it's cheap. It's because it's in the price, it's not going to hurt us to top it up. And if you do that, you wind up with a portfolio that has a stark value tilt, a big value tilt, just as big a value tilt on average as the cap-weighted value indexes. But unlike the cap-weighted value indexes, it has a rebalancing alpha. If a stock rises and its fundamentals don't, you're going to say, oh, thanks for the higher price, I'm going to trim it. If it tanks and the fundamentals don't, you're going to say, thanks for the deep discount, I'm topping it up. The market thinks prospects have gotten better. Don't worry about the higher price. It's going to show up in the fundamentals catching up because that growth is coming. And that narrative might be correct, but it's in the price. So the rebalancing alpha of RAFI, of the fundamental index, is its secret weapon. It's not the value tilt. The value tilt is powerful, but value is an unreliable alpha engine. Rebalancing is a more reliable alpha engine. Here's a fun factoid. RAFI's been around since 2004. It's been live since the end of 2004 in the US, international and small 2005, emerging markets 2006. So it goes way back. Put those together in a global frame. The FTSE RAFI All World 3000 includes US, international, large and small, and emerging markets. That index has been around since 2005. Now, how's it done since then? If you look at it on a standalone basis, it's performed very well for value. It's beat the market inception to date, even though value's gotten savaged. But where it really shines is relative to value itself. There's multiple flavors of RAFI. There's FTSE RAFI, Russell RAFI. There's multiple flavors of cap weight. There's MSCI ACWI and FTSE All World. Okay, let's take blend of these two RAFIs and these two cap weight value indexes. Okay, so I'm not cherry picking for the best relationship. I'm just looking at RAFI versus cap weight. The value add over the last 17 years has been 4,700 basis points. That's 2.3 per annum compounded. The tracking error has been 1.5%. So you have an information ratio of 1.5. The worst drawdown ever was 1.9%. The longest drawdown ever was 7 months. And so you have this relentless alpha engine. And the T statistic is 6. I haven't seen simulated back tests with a T statistic of 6. And here's a live strategy measured against a live cap-weighted value index with a T statistic of 6. So the critics of RAFI who said this is just a clever repackaging of value investing Well, let's take that at face value. It does have a deep value tilt. But if it's just repackaging of value, then the relevant benchmark is value. And here we are comparing it with value, and you've got a T statistic of 6. It's astounding. For what it's worth, I have a swap, long RAFI, short cap weight value in my personal portfolio, and it's doing very nicely.
And then just to put those numbers in English for everybody to understand, basically outperforming by over 2% a year for 17 years and doing it relatively consistently.
That's exactly right. There's no drawdowns that weren't recovered to a new all-time high in relative performance. It always happens in less than 18 months, at least over this 17-year span. So the point of this is not buy RAFI, although if your viewers choose to do so, that's fine with me. The point of this is to say a rebalancing alpha is enormously powerful as long as you do it systematically. But if it systematically goes against human nature, because you're buying what's out of favor, what's newly unloved, what's newly disappointing, and you're selling what's newly beloved, what's people are piling into, and it just goes against human nature.
So related to that, would you just talk about the difference between the performance of a value stock versus a value company? And I guess you could do the same thing with a growth stock versus a growth company. One could be doing really well versus the other not doing so well.
Yeah, this is something that's been discussed and well known all the way back to Ben Graham's time. Ben Graham famously said that he thought of the stock market as, in the short run, a voting machine, popularity voting machine, and in the long run, a weighing machine. Is this worth what it's priced at? Another way to put this in finance theory terms is it's an error in price model where the price is the market's best guess at fair value. The fair value is constantly moving as news comes in. The price is constantly moving, and the price is hunting for that value, that fair value. So the price equals the fair value, which we can't see, plus or minus an error. Now, why does that matter? That error is mean reverting. The market's constantly hunting for errors in price that need fixing. That is the engine for a long horizon mean reversion.
Yeah, that's pretty fascinating. And I guess if you, I know Research Affiliate spends a lot of time creating long-term expected returns across asset classes. You have tools that do that. And I think the key there is that in many ways, it's easier to predict long-term returns across markets than it is short-term returns, which can sound very counterintuitive to most people because in the real world, short-term is easier to predict than long-term. Would you describe that?
Absolutely. Is NVIDIA going to be a brilliant stock for the balance of this year and next year, or is it going to mean revert downward, or what? I have no clue. And by the way, just as an aside, I strongly recommend against shorting things that look like bubbles, because bubbles can go a lot further than you ever could imagine. So be careful, do not short bubbles. But long-term returns are actually surprisingly easy to predict because they have very few moving parts. You've got your income, the yield. You've got growth in income. For fixed income, it's zero. For junk bonds, it's negative because there are some defaults. For stocks, it's positive with an inflation kicker and a real growth kicker. But you've got income and growth in income. And then you have changes in valuation multiples. So I like to use the Shiller PE ratio. Shiller PE ratio for the US stock market is now 34. You pay 34 times the 10-year average earnings for the S&P 500. If there's mean reversion in earnings and if there's mean reversion in valuation multiples, those can both work against you in these markets at this time. So past is not prologue. The trailing 15-year returns for the stock market have been stupendous. But that doesn't mean the next 15 years is going to be stupendous. Long-term returns consist of yield, growth, and changes in valuation multiples, which tend to be mean reverting. So, what does that mean for U.S. stocks? Yield is less than 1.5%. You put $100 in the stock market, you're going to get income of less than 1.5% for S&P or Russell or a broadly diversified portfolio. That's a pretty crummy income stream. Growth. Wall Street says, don't worry about the 1.5%. You're getting 10% from growth. You're investing in growth. Pardon me, but going back over the last 50 years, 100 years, 150 years, 200 years, you find that earnings and dividends tend to grow about 1.5%, at best about 2% above inflation. So, expected inflation on a 10-year basis is currently 2.3%. Let's call it 2.5%, just to round it. Add in 1.5% for real growth, and you've got 4% growth, not 10% growth. 4% growth and 1.5% yield gives you 5.5% as a return expectation. That's not brilliant. Well, what allowed the returns in the last 15 years to be so spectacular? Revaluation. The valuation multiple 15 years ago, keep in mind, 15 years ago was just coming out of the global financial crisis. So 15 years ago, price relative to 10-year average earnings bottomed out at 12 times. By mid-year 2009, it was about 14 times. Now it's 34 times. So valuation multiples have well over doubled. That's a dangerous part of return to extrapolate. So the inspiration for our work on capital market return expectations was Jeremy Grantham's work at GMO. He does long-term return expectations and has been doing it for decades, using yield plus growth plus mean reversion and valuations. And I think his approach makes an important mistake by assuming you're going to fully mean revert back to historic norms over the next 7 years. So the normal Shiller PE ratio, price relative to 10-year smooth earnings, over the last century has been about 18 times. So going from 34 to 18 times, that's almost dropping in half. You're going to have a negative return expectation. I view that as the tail wagging the dog. What if we're at a new normal and 10 years from now we're still at 34? Well, then you get your 5.5%. What if you mean revert back to 18? Then you're at a negative return. Well, let's split the difference. What if you just go to 20, 25, 26? Still expensive 10 years from now. Not full mean reversion, but a little bit of mean reversion. Now you're down at about a 3% return. So our forecast for U.S. stocks is a 3% return. People are horrified by that. You can get 5.5% from T-bills. So why on earth would you put money in stocks at a 3% return? Folks who are watching this, I would invite you to look at our website. Just go to researchaffiliates.com, and on the upper right of the home page, there's Asset Allocation Interactive. You just click it. Or you can Google Asset Allocation Interactive, and the first thing that's not an ad is a link that'll take you straight there. We provide forward-looking return expectations for 130 different asset classes, and the price for this service is classic internet pricing. It's free. 3% return for stocks. We're projecting 4% for T-bills because if inflation is 2.5%, 5.5% won't stick. It'll come back down. Why invest anywhere? Those returns are terrible. You look at EFA, the MSCI International Index. It's priced to give you 9%. Emerging markets, 9.5%. Value within the U.S., international, and emerging markets, priced to give you 3 to 4% more. Well, 3% more than 3 is 6. That's still pretty crummy. 3% more than 9.5 is 12.5. That's pretty good. That'll double your wealth every 6 years. So I look at the world of today and I see a lot of interesting places to invest. I've been called a perma bear because I don't like buying things that are fully priced or expensive. I'm not a perma bear when something's cheap. And right now, there's a lot of things that are cheap.
So one of the things that we talked about is as kind of the golden rules of investing is buy low, sell high. We understand that theory works well in practice. It's hard to do.
It's painful to do. One of my favorite Soros quotes is that investing shrewdly and wisely is fundamentally a painful exercise because you're going to do what doesn't come naturally. You're going to do what's out of favor and uncomfortable. You're going to feel like you took stupid pills until the turn happens. And sometimes the turn doesn't happen. So this is why you diversify, because you could be wrong.
That's right. Yeah. So rule number one, buy low, sell high. Rule number two, you just said it, is diversification. And the simplest way to articulate that is don't put all your eggs in one basket, which is you're taught. That's one of the first things you're taught in investing. And in my experience, the conventional allocation, the typical portfolio is not very well diversified. I'm curious if you agree and if you could expand on that.
I emphatically agree. You look at most 401k platforms, and let's say they have 30 different investment options. I mean, some have scores of investment options, some have only a half dozen, but let's say you've got 20 options. 16 of them are going to be various flavors of stocks. A couple of them will be various flavors of income, bonds, and you might have a couple of options that are a little out of mainstream, like a REIT fund or a TIPS, inflation-linked bond fund. One factoid that's really interesting is if you have 20 options available to you, the average allocation is going to be about 5% to each across all of your employees, which means that if 80% of the available choices are stocks, they're going to be on average 80-20. 80-20, if it's stocks and mainstream bonds, is not a diversified portfolio. It's a stock portfolio, typically overwhelmingly domestic stocks, with a little dose of bonds that don't provide diversification, they just tamp down the risk. Shockingly, a 60-40 portfolio, the classic balanced 60-40 portfolio, has a 98% correlation with the stock market. Stocks provide risk and a risk premium. Bonds provide risk reduction, not a risk premium. And so the ability to find diversification is almost absent from most 401k platforms. So I think Harry Markowitz was a dear friend of mine. He often said his most important contribution to the world of finance was the recognition that diversification matters. Diversification doesn't mean 6 different stock funds. Diversification means a little bit in various buckets that don't move together, that move at different times, that reward you at different times. And one of my former colleagues is fond of saying diversification is a regret maximizing strategy. In a roaring growth dominated bull market, you regret every penny you have in diversifiers. When that comes to a screeching halt, you regret every penny you don't have in diversifiers. So after the 1990s, we had the decade of the 2000s when the stock market return was negative in real terms. Bond market return was decent, and diversifiers had very healthy, strong real returns. Decade of the 2010s and early part of this decade look an awful lot like the 1990s. I see a lot of parallels between right now and the year 2000. That doesn't mean that I think this market is coming to a screeching stop right now, but it does mean that we're in frothy, dangerous territory.
You talked about the last couple decades, and we were speaking briefly before we started recording about how memory can be very short in the investment world. So people are thinking about the stock market go straight up. It's had a 15-year bull market. 15 years is a long time. In market terms, it's not a long time. It's almost like one, you can think of it as one data point. And you just mentioned the decade before that, the stock market lost money. Would you help investors gain some perspective on long-term market cycles so they have a better sense of how markets can go through long periods of underperformance?
The markets move in what are commonly thought of as bull and bear markets, with bull market reaching a new high and then the bear market taking the wind out of the sails and then a new high and so forth. You also have secular bear markets that 1966 to 1982, the market was lower in the summer of 1982 than it was in the spring of 1966. Lower, even though we'd had a decade and a half of severe inflation, meaning that in real terms, the market was down by about 2/3. You lose 2/3 of your money in the space of 16 years. That's a secular bear market. 2000 to 2009, you had a horrible bear market, a beautiful bull market, a horrible market crash. Net, from 2000 to 2009, you lost a lot of money, especially adjusted for inflation, which was modest then, but not negligible. Net of inflation, you were down by well over half in the space of a 10-year span, and you're supposed to make money over 10-year spans. Come on. What's the whole point of long-term investing if you can't make money in a decade? Well, there are decades where you can't. My unease is that I think for U.S. stock investors, we might be looking at that kind of decade in the coming decade because valuations are very high, optimism is very high, and there's lots of markets that are priced cheaper that you could move money into that are priced to give you a much better return. Value, non-U.S. stocks, emerging market stocks, maybe REITs, although I'd want to average in carefully. MLPs are, a lot of them are in the resource sector, which is very out of favor. And MLPs were very popular a while back, not anymore. So they're priced to give you pretty darn interesting rates of return. So I see lots of places to invest that look really very interesting. But most people have most of their money in mainstream U.S. stocks that are frothy and mainstream U.S. bonds that have a respectable yield finally again, but not a great yield.
Yeah, and this goes back to where we started, diversification. And it's interesting when you look backwards, 10 years, maybe even 15 years, the more you were diversified, the worse you did. The less you were diversified and the more U.S. stocks you owned, the better you did. So that has maybe taught us the wrong lesson. And when you zoom out and look at longer term market history and gain that perspective, you see the benefits of diversification through time. And I think when you look forward, to me, it's a very simple question. Is this a world looking forward that you want to be more diversified or less diversified? And I think if you ask that simple question, most people would say it's probably a good idea to be more diversified. There's just a lot of risks on the horizon. Yet most people are less diversified than they were 10 years ago.
Very, very, very true. I look at I talked earlier about short-term, high-frequency trading versus long-term investing. I think quantitative techniques in general, AI more specifically, work magnificently in short horizon trading. And you don't need theory if you've got billions of samples of data. When it comes to long horizon investing, the data is not going to help you because there's not enough data. So just drawing on simple facts like what's the yield, what's the historical growth rate, if there's mean reversion, what would that do to our returns, gives you a window into long-term returns that's actually shockingly clear and shockingly accurate. If you go back historically and just use that very simple yield plus long-term historical growth in income plus halfway mean reversion spread over the next 10 years, you find that that leads to forecasts of long-term returns that on average are within about 2% per annum. That's pretty good. AI is not going to help you there. And so I find long-term investing to be the antithesis of crowded space. Very few people pay attention to long-term prospects when they're surrounded by buzz about this company or that. The CNBC and MSNBC approach to making a sport of investing, to treating investing as a day-to-day opportunity to make a bet, is actually pretty dangerous.
You talked about the potential similarities to the 2000s. Are you finding any analogies in terms of how today looks versus the 1970s, the last time inflation hit high levels? And would you remind everyone how stocks and bonds did during that period?
Yeah, no kidding. The 70s were awful for stocks and bonds. We came into the 70s with stock market in 71. Shocking to hear this, breached 1,000 for the Dow Industrial Average for the first time. 1,000. It's now rather ahead of that level. This was a decade in which you had serious inflation. March of 1980, inflation crested at 14.7%. 1971, inflation was rising, but was at the alarming level of about 3%. All right, what happened? The Dow crossed 1,000 for the first time ever in 1971. That's a shockingly low number today, but it bottomed in 1982, 11 years later, at, I believe the number was 700. So you were down by a third on an 11-year basis at a time when inflation was running double digits a lot of the time. So a lot of money was lost. Bonds had a horrible time. Interestingly, there was something called the yield book back in the early 70s, which was big bond houses like Salomon Brothers had a book that allowed you to convert yield to price. And the book stopped at 6%. So a friend of mine, Marty Leibowitz, became one of the youngest partners in the history of Salomon Brothers by dint of using a calculator to create a yield book that went beyond 6. And yields reached 12% in late 74, early 75, reached 15% in 1982 with T-bills cresting at 20% in 1980. If yields are going from T-bills going from 3 to 20 in a dozen years, that's not going to keep pace with inflation. And if bonds follow suit, you're having capital losses on the bonds because higher yields mean lower prices. So it was the worst decade in history for the bond market. And it was one of the worst decades in history for the stock market. Only parts of the 1930s were worse. So you have periods of time. Stagflation is a terrible thing. And current policy seems to be reckless on the spending side. Before the call, or early in the call, I mentioned that our work on spending suggested that spending leads to slower growth. If you have soaring spending, you're going to have sluggish growth. If you have soaring spending and there's no place to put it and it makes its way into the economy, into people's pockets for spending, inflation is just a matter of supply and demand. More money in your pocket means more demand. disincentives for creating goods and services creates reduced supply. Supply chain disruptions from overregulation lead to reduced supply. Higher demand, lower supply means inflation. It's that simple. And people overlook the fact that it's that simple. In the 70s, we had soaring inflation that didn't get under control until Volcker took drastic measures and imposed extreme pain, imposing a double dip severe recession on the country. He got away with it because the country had experienced inflation for a decade and was just sick of it. I don't think our country is sick of it enough yet to demand harsh medicine, nor is this Fed showing any signs of wanting to impose harsh medicine. So I look on the current situation as having downside risk that's comparable to the 70s. Now, a lot of what we've been talking about is bad news or dangerous news. I'm an optimist long term. Bottom line is we're in the best of times. Politicians get votes and media gets eyeballs by promoting fear and anger and talking about how awful things are. Things are actually pretty damn good. And that's part of the reason that the markets are so expensive. They're expensive because you can look way down the road and accept a relatively low excess return, a relatively low risk premium, a relatively low discount rate. You can't do that in a world of horrific tumult, short life expectancy, and high risk. So in some ways, we're in the best of times.
Yeah, and then relating all that to the portfolio side, you can drastically reduce the risk of suffering pain through an environment like the 70s or the 2000s by just being better diversified and own things that do well in those environments. Is that right?
Absolutely right.
So if we look forward to growth and inflation, and in particular what's discounted, when you look at that, where do you see the asymmetry and the mispricing?
I see the asymmetry between growth and value. As with the summer of 2020, the bricks and mortar side of the market is being written off as dead. You mentioned earlier the difference between growth and value companies and growth and value stocks. The simple fact is a stock is not a company. Stock is an investment in a company, which can be expensive if the growth prospects of the company are perceived as brilliant, or cheap if the growth prospects are perceived as lousy. That embedded narrative is the expectation. The reality is different from that. And you can have a growth stock that's that is disappointing as a company, and you can have a value stock that exceeds expectations as a company. The narrative in the summer of 2020 was that the bricks and mortar businesses were going to see rolling bankruptcies, the likes of which we've never seen. It didn't happen. It didn't happen partly because of massive stimulus, which did cherry pick winners and losers, but was also a flood of money that helped companies survive. And also the vaccine coming along just a year into the pandemic meant that we could go back to business as usual quicker than we would have otherwise. So the value companies did fine. Right now, we're again in a narrative where the growth companies are creating artificial intelligence that will radically reshape our future. And these companies are amazing and will be massively successful. They are amazing. And they might be massively successful. They are massively successful today. They may have headwinds in the future. I don't know. But the value companies are also doing fine. Most of them are doing just fine, which means that the pricing that says these bricks and mortar companies are in deep trouble doesn't make sense. They're too cheap. So I look at the disconnect between value companies and value stocks. Value stocks are cheap. They can see stupendous growth in price, even if the companies don't see stupendous growth in the underlying business, because they're priced to reflect an expectation of really bleak outlook, which isn't fair. I mean, a lot of those companies are doing fine.
And how do you think about just the consensus view on economic growth for the economy as a whole, and also inflation? What's priced in for inflation, and where do you see the asymmetry in those two metrics?
Okay, there's 4 warning signs that are flashing amber. How is it that this economy is booming in the face of those headwinds? Very, very simple answer. A wealth effect from a bull market and consumer spending. During the pandemic, consumers were spending like there's no tomorrow because a lot of them thought there would be no tomorrow, so might as well spend it. And those patterns die hard. Once you've gotten accustomed to overspending, it's hard to cut back. So overspending means credit card debt starting to soar, cash reserves depleted. That's happening. And with consumer spending being elevated and a wealth effect from the stock market, those are holding the economy up. Now, the question is, will the 4 measures that I just described improve back to historic norms before this runs out of steam? If it does run out of steam, then you get a slowdown at least, and a recession not improbable. Jamie Dimon, about 2 weeks ago, was quoted saying, "A hard landing is not off the table. It could easily happen." We would agree with that. We would agree that a hard landing is not off the table. It's not the high odds central expectation, but the notion of a booming economy with persisting well into the future, with inflation continuing to moderate on the downside, is the consensus of the market today. And both of those risks are asymmetric. Inflation risk is asymmetric to the upside. Economic growth risk is asymmetric to the downside. And we're spending like there's no tomorrow, which leaves little dry powder for trying to stimulate our way out of a recession if we have one. Not that stimulus works very well anyway. It only works on a very short-term basis. So we're looking at an array of risks which, in a perfect storm, would lead to a return to stagflation of the 1970s. I'm not saying that is my central expectation. I am saying it is a risk that is not priced in by the market. So having a little part of your portfolio that would do well in that circumstance is a very good idea. You don't invest all your money in that. You diversify.
AI is going to have massive long-term economic implications, and it's going to change the footprint. Do you see asymmetry in its outlook? Do you think it's equally likely that it underperforms the lofty expectations that currently exist, or outperforms?
AI is going to outperform lofty expectations, but on a much longer horizon than the market currently thinks. AI is not new. I was doing neural networks in the 1980s. They didn't work very well. That's where I first realized that if you have thousands of samples of data, AI is useless. But AI has been around for decades. AI has been used in significant ways for decades. The military uses it for fast response. High-frequency trading companies use it to figure out which way the next tick move is going to be. These are great applications for AI. What is new is user-friendly AI. You can type a question into ChatGPT, or if you're a graphic artist, you can ask DALL-E to paint you a picture of thus and such and just describe it and have it done. And it's shockingly good, but it's also not ready for prime time. When ChatGPT first came out, I asked ChatGPT to write me a children's bedtime story with knights and unicorns. And it came out with a 500-word story that was so sweet, so nice, and so fun that any child's book author would have been thrilled to put their name on it. I then asked it to write my bio, and it said that I had an MBA from University of Chicago and started my career at Goldman Sachs, all of which is news to me. But that's often referred to as AI hallucinations. AI gets basic facts totally wrong. So it's not ready for prime time, but it will be very soon. And uptake by people using it will take longer. It's just like Facebook and Google weren't even around, but they were new a few years into that decade, and they weren't widely used until a few years after they became readily available. Same thing holds true for user-friendly AI. It's going to be big. It's going to change the world over the next 20, 30 years more and in more ways than we can possibly anticipate today. But it'll take time. And so that's where the market's got it wrong, I think. The market is projecting that the near-term growth will be stupendous and the headwinds non-existent, and also assumes that the winners of today will be the winners of 5, 10, 15, 20 years from now. Like I said, the 10 most valuable tech stocks in the world in the year 2000, 0 had beat the market 15 years later. That's a shocker.
It is. Rob, I appreciate you sharing your insights with us today, and I enjoyed the conversation. I hope you did as well.
Alex, this was great fun. Thank you very much, and thanks for the great roster of questions.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.